to me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated. Again, trying to stick the landing. And long story short, he didn't. That was a head fake. And the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that. At least in the next 30 to 90 days, the pain trade is to go up. So that's probably where we're going.
Chamath Palihapitiya is of the viewpoint that the path of most pain for markets over the next 2 to 3 months is to rip higher before coming back down. Despite his prior hawkish stance, markets are now believing that Fed Chair Jerome Powell may actually be able to pull off a soft landing. Whilst many experts initially predicted a hard landing due to aggressive interest rate hikes in 2022, a softer landing is beginning to seem increasingly likely after the Fed's recent 25 basis point hike and the possibility of only one more. In his latest podcast, Chamath Palihapitiya points out that he has seen this scenario play out before in 2019 and breaks down exactly how he sees it unfolding moving forwards. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
That's right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. You know, there's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend. Because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy. And the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now. The big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think, again, the marginal risk will be that we do whipsaw as Sachs. I think that there's a lot of those testing the waters that are now starting again. Most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers and they basically are the ones that sell into these guys. And then that's what inflates these prices. And similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days. Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is.
Yeah. That's why the market ripped. I mean, basically, that was all part of a narrative where inflation's on its way out. We've licked that problem. And that's what the market was pricing in. And I think now the question is, in light of today's jobs report, is that actually true or not?
Disinflation, not deflation.
Disinflation, yeah.
Disinflation.
So one way to look at this is, Jake, how you showed the chart of the Fed funds rate. Another chart is the yield curve. This is the yield on U.S. treasuries, on our T-bills. And one way to look at this is as a prediction market of where the market thinks interest rates are going. Because the Fed sets the rate for the Fed's funds rate, which is the overnight rate of lending to banks. But they do not set the rate of 3 months, 6 months bonds, 10-year bonds, and so on. The market does, because the market trades those bonds, imputes a yield that the market requires to want to hold those bonds. So what's interesting is that if you view the yield curve as a prediction market, it tells you at any given time what the collective wisdom is of the market. Now, this thing is fluctuating, moving all the time. So that collective wisdom is changing. But where things are today is pretty interesting. It looks like what the market is saying is that within the next 6 months, the rate peaks at 4.75%. So Nick, if you just want to hold the mouse on the 6-month dot, you'll see it's 4.76%. So basically the market is predicting we get maybe one more quarter point, roughly, not much. And then if you go to the 2-year, it's at 4.09, so a little over 4%. So what the market is actually predicting is that over the next 2 years, we're actually going to get a 50 basis point decrease from the Fed. And then if you go to, say, the 5-year or the 10-year, we're at 3.5%. So the market's basically saying that long-term rates are going to stabilize at 3.5%. We're not going back to the abnormal zero interest rate policy, or ZIRP, that they had for 10 years. 3.5% will be the long-term stable, cost of money. But you can see that the market, the prediction market, thinks that the Fed has done enough to combat inflation, because the Fed funds rate now basically is where the bond market thinks it should be. And in fact, the bond market thinks it's coming down over the next 2 years.
If you listen to Buffett's teacher, this guy, Ben Graham, in Ben Graham's book, the way that he would look at a stock, and obviously, look, things have changed, but the way that he would look at a stock is he would look at that risk-free rate, he would double it, and then the inverse of that is the maximum price to earnings ratio that he would pay for a stock, right? That's the trade-off, is if you can get more than 2 times the risk-free rate, then it's worth owning a company. What that means is that if you take 3.5% as a terminal rate, the right PE is around 14 for the S&P 500. Right now, the S&P 500 trades at 22 times PE, which would mean that we are 50% overvalued. Now, that, again, that's a Benjamin Graham model, and I think the world has pretty cleanly moved away from it. But there's probably some rooting in that intellectual framework that's still valuable. And to your point, David, it just reinforces that, man, we need to start to learn a new regime here, because when rates are not zero, there's just a lot of excess that you can't support, because the alternative trade-offs for investors are plentiful, and plowing money into a money-losing startup becomes less attractive. I watched Powell's speech, and it was really amazing, because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 2 25 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this. Trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go